$22 trillion. That's the combined market cap of just 7 companies betting their futures on AI. Add the private labs, the bond markets, the private credit exposure, and you're looking at a financial ecosystem so concentrated, so interconnected, that some people are asking what we used to only ask about banks. Are these companies too big to fail? I recently produced an episode that predicted OpenAI would be the first of the AI hyperscalers to fail. Many of you posted in the comments that it, with the other big AI companies, are effectively now too big to fail. The US government would ultimately bail them out with some kind of package or financing deal. After doing a bunch of research, these commenters may be right, but I'm not convinced, so let's get into it. We all remember 2008 and 2009 when Wall Street, banks, and mortgage originators got greedy. No income, no job, or what was affectionately called ninja loans were being handed out like comedy show flyers in Times Square. Wall Street and banks figured out ways of reselling, repackaging, and reselling again mortgage-backed securities. Then the defaults came in, and Wall Street figured out how they could sell credit default swaps, digging the hole even deeper. Ultimately, the Fed stepped in to force bank mergers, fund huge bailouts, and claim those they bailed out, namely the banks, were too big to fail. Fast forward to mid-2023 and the rise of the Magnificent Seven, or Mag 7. That includes Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. In that year, those 7 stocks represented 74% of the S&P's annual gains. 74%. 2023 was also when those same 7 stocks, maybe minus Apple, really started talking about AI and how it was or would be integrated throughout their product lines or be cornerstones of their business models. By mid-2024, the S&P 500's gains were driven almost exclusively by its 6 largest stocks, with enthusiasm about generative AI cited as the catalyst. Nvidia alone accounted for nearly 1/3 of the S&P's gain in that period. Scott Galloway, among others, distilled the investment thesis of the entire US stock market to one big, quote, AI trade. During that mid-2024 timeframe, the Mag 7 was carrying a forward-looking price-to-earnings ratio in the mid-30s. Comparatively, the rest of the S&P was trading at a PE ratio around 18. In October of 2025, the Mag 7 had a combined market cap of $22.3 trillion, and that was only the public markets. Venture capitalists and private investors were dumping billions into companies like xAI, Anthropic, and OpenAI. As of the time of this recording, it's generally understood those 3 companies raised a combined $297 billion. Just those 3. You know, one of the best ways to support small YouTube channels like mine is to subscribe. If you like the content and you'd like to see more of it, consider subscribing. Back to the episode. So between the publicly traded Mag 7 that was now squarely the core of the AI trade and the top 3 private AI labs, investors were all too happy to plow investment capital into these increasingly consolidated asset classes. Meanwhile, what many fear could be a market-destroying bubble with inflated PE ratios or privately implied valuations exceeding 400x was getting bigger. So there's the setup: incredible amounts of capital consolidated in a handful of companies, all chasing market recognition for being the preeminent AI company. For their part, public and private equity investors were now betting the farm on that same handful of companies. So why would these companies be considered too big to fail? The core arguments fall into a few buckets. First, these companies all need to spend billions every year to build the infrastructure to deliver their AI products. According to the Bank of International Settlement, quote, analysts' forecasts indicate that annual spending on data centers alone could increase by between $100 billion and $225 billion in the next 5 years, end quote. Almost without exception, these hyperscalers' spend commitments exceed their operating revenue by 80 to even 100 times. This means they must raise capital from investors in the form of equity or debt to make up that delta. BIS went on to detail this explosive growth in debt financing. Quote, the share of private credit loans to AI-related companies has increased from less than 1% of total outstanding loan volumes to almost 8%. And it's estimated that outstanding private credit to AI firms could reach between $300 billion and $600 billion by 2030. For perspective, The total private debt market in the US is currently estimated to be $1.5 trillion. So adding BIS's projection to that total, AI loans could be as much as 35% of the total private debt market by 2030. And it's not just these private hyperscalers. According to NPR's Marketplace, quote, Amazon, Meta, Alphabet, and Oracle all sold bonds last year to fund data center construction. Meta sold $30 billion in bonds in October, marking the single biggest offering in the US high-grade bond market last year, end quote. It's easy to see, given these numbers, how defaults could crater the entire private debt market and its intermediaries. Second, according to CNBC, artificial intelligence contributed as much as 40% of the growth of the US GDP over the last year. JP Morgan agreed, pegging the combined economic impact to GDP at just over 1%. In case you're thinking 1% doesn't really matter, the St. Louis branch of the Fed estimates 1% to be worth as much as $280 billion a year. Couple this with the accelerated spend on AI data centers and infrastructure, and PwC estimates AI could add as much as 14% to global GDP by 2030. That's roughly $15.7 trillion in global GDP expansion that, if not for AI, wouldn't happen otherwise. Third, there are significant operational dependency risks because a handful of companies control the majority of models and chips. This creates a series of cascading issues. Chief among them is resiliency. If one of those models goes down, is hacked, or otherwise compromised, the financial impact for each incident could be extreme. While not specific to AI products or service, Dun & Bradstreet reported, quote, 59% of Fortune 500 companies endure a minimum of 1.6 hours of tech or provider downtime each week, averaging a weekly cost ranging from $640,000 to just over $1 million. Extrapolating that across the entire cohort, and it could be $295 million per week. To be fair, AI corporate adoption is lagging even such dated tech as legacy telephony systems, so we aren't to that level of impact yet, far from it. But as AI adoption grows, its downtime impact could explode. Fourth, given everything I've already covered, it's almost impossible to believe the US government wouldn't consider a bailout given some catastrophic shock in the AI market. They could point to any of these consequences as existential threats to our economy or even national security. You may think that's hyperbolic. That doesn't matter. The Fed will have all the cover it needs to bail out some or all of these companies. To remember, the CFO of OpenAI publicly and unapologetically floated her tacit expectation the government would offer some form of financial safety net or bailout when or if the necessity arose. She was rather matter-of-fact when she said it, like this was a foregone conclusion. And we've already seen the Mag 7 CEOs fund inaugurations, placate President Trump with weird and inappropriate gifts, and attend photo op-ready dinners. They understand how this game is played, and to a deeper extent, just how screwed they are if they can't use the Fed as a backstop. And those public CEOs aren't the only ones with ties to this administration. Investors like Mayoshi Son of SoftBank, who has an estimated 10% stake in OpenAI, has direct ties with President Trump. OpenAI and Sam Altman are partnering with the administration on the Stargate Project, and OpenAI's co-founder, Greg Brockman, gave $25 million to Trump's super PAC. Seems a quick trip for dinner or a round of golf at Mar-a-Lago could secure some kind of federal assistance, up to and including a full-on bailout. So what's the counter-argument? Here's why AI companies may not be too big to fail. Outside of Tesla, I don't think any of the Mag 7 are in real threat of collapsing. Most of them are sitting on cash or access to cheap capital and could survive material reductions in their operating revenue for some real period of time. I mean, most of these could split their stock and generate hundreds of billions in short order. An AI bubble bursting would certainly disrupt markets and have a detrimental impact on most portfolios. But it's reckless and intellectually lazy to equate that potential to what happened in '08. Had the Fed not intervened during the bank bailout, the second-order effects of that crash alone would have dwarfed any potential AI bubble bursting on orders of magnitude that make that comparison irrelevant. AI is a major economic engine, no doubt, but we were talking about the collapse of credit, banking, and housing in the United States. These two things are truly incomparable. Okay, but what about the private companies? What about OpenAI or Anthropic? Well, first, I think they both go public in the next 12 to 24 months and then are afforded some of the same insulation I described for the Mag 7. Second, you have to remember they have investors on their cap table that could easily absorb them. Microsoft and Amazon are on both cap tables, OpenAI and Anthropic. If either of these struggle, the tech gets transferred into some special purpose vehicle, a whole new company, or something, run by very capable executives at Microsoft or Amazon, maybe even Nvidia. Some stock exchanges hands, investors take a temporary bath, but users can still access the models, corporate integrations and product development continues, and only the names change. Attempting to square this circle, as they say, I think these companies failing would be painful, but not on the scale of too big to fail, a term that was appropriately and proportionally coined during the banking and credit crisis of 2008. Politically, I could definitely see the government stepping in to offer some kind of bailout package, especially if this hit the public markets. But structurally or economically, I'm not sure failed AI companies will have the expected impact doomsayers are predicting on the daily. AI adoption is weak in relative terms, especially corporate and enterprise adoption. AI has minimal economic benefit for the average American. As HSBC put it, quote, "The AI investment boom is failing to drive significant direct job growth and mainly benefiting higher income households through equity market gains. For many households, the benefits of the AI boom are muted. Strong gains in equities and mutual funds have supported net worth for wealthier households, but real household net worth, adjusted for inflation, is not unusually elevated," end quote. In my opinion, the companies that are most vulnerable are still private. So those private investors get smacked in the mouth, but the immediate blast radius is somewhat limited to chip and infrastructure providers. That's not to minimize that impact, but this isn't Lehman Brothers collapsing and threatening to bring Merrill, B of A, and Goldman with them. Nvidia, Google, Microsoft, Amazon, AMD, and a handful of others would see their share price take a few haymakers, but ultimately recover because the AI demand is unlikely to disappear. And let's be honest, most of these models are fundamentally interchangeable at this point. I get that each LLM model has particular strengths and weaknesses, and most avid users utilize multiple models for different tasks, but those differences will be less and less distinguishable over the next few years. The rate at which these models learn, develop, and evolve is accelerating, and there will be, in my opinion, what mathematics calls a convergence to a mean. They'll all end up at the same metaphorical point, where they lose most of their primary functional differences, and barring significant divergence from that mean, model interchangeability becomes almost inevitable. So there it is, more doomerism around AI, projecting irrational fears and worst-case scenarios that are, at best, improbable. This notion of AI being too big to fail makes for great headlines and click-through rates, but the math, economic analysis, and market realities just don't support it. So for my viewers that despise AI, I get my take may be disappointing, but there are still many things to loathe about AI. Go check out Palantir. Plenty of monumentally heinous behavior going on over there. Here's what I keep coming back to. The most dangerous part of too big to fail isn't the failure, it's the too big part. It's the moment a handful of companies get so deeply woven into markets, into government relationships, into the retirement accounts of ordinary people, that their bad decisions become everyone else's problem. We've been here before. We know how this ends. I'm not convinced the sky is falling, but I'm also not convinced the people building these capital vaporizing companies are losing any sleep about who cleans up their mess. That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.